Hey there, this is David McElfresh, and this is this week's Fresh Take. I'm really excited. So, this week we're going to be diving into a two-part series. The topic that I'm going to be covering over this week and next week is comparing real estate investing and looking at how it compares to investing in the stock market. I've compiled my 10 favorite reasons for why I prefer real estate investing over stock investing and why I prefer all of those investments, why I think that they do better, and all of that kind of stuff. So today we're just going to cover the first five, but let's go ahead and dive right into those points. So number one, super common one, but for me, I think one that's probably one of the most important is leverage. Okay, leverage is the concept that you can go to a bank, you can get a loan, and you only have to bring part of the down payment to purchase the home or purchase the asset, as you should look at it. So, in my opinion, it's one of the most overlooked of the tools or the reasons why real estate is much, much more powerful than investing in stocks. But let's take a look at this for a second and just talk about an example. So, let's say in the stock market, you went ahead and you invested $10,000 in a single stock. Okay. Over the course of the year, it does really well and it goes up by 10%. Okay. That's a really good return in the stock market. Now at the end of 1 year, your investment is $11,000. It's gone up by $1,000. It's a nice return. You're not going to necessarily get rich by any sense with that sort of a return or anything like that. So for me, it's not necessarily a really, really profound wealth building strategy, but let's assume very, very similar situation, but you're going to go and you're going to buy a $200,000 home. Okay. You're going to use the exact same $10,000 as a 5% down payment to purchase the home, and the home appreciates at about 4% a year. Okay, that's a little bit less than average. Now, at the end of 1 year, that home is worth $208,000. So your equity's gone from $10,000 to $18,000, and you've nearly doubled your money in 1 year. Okay, that's a pretty awesome strategy. That's a pretty awesome tool when you're comparing the two. So let's look at this question from another angle, because this is something that I like to think about a lot. Why can't the average person go to a bank and get a loan to invest money in the stock market? Sounds a little bit strange, doesn't it? It's not something that somebody would normally do. People don't do that. But think about that concept. Banks are really, really smart. They're really good at making money, and they're really good at minimizing their risk. Bankers are not willing to give money to the average investor to invest in the stock market because the stock market is way too volatile. But banks are more than willing to invest money in what I would call educated bets or the average homeowner, assuming that they go through all the checks and balances, assuming that they qualify, assuming all of the things that you normally have to go through in order to purchase a home. In fact, if you look at just the amount of loans that were generated over the last 12 months, banks were willing to lend out more than $2.5 trillion worth of home loans. Okay, a crazy amounts of money. So I just like to think about that concept. If you look at this from a lens of an institution that really, really understands risk and understands getting your return on investment, banks are much, much, much more willing to lend and give leverage towards investing in real estate than they are in the stock market. So that's point number one. Let's move on. Point number two, cash flow. So cash flow is a really, really cool tool. It's one thing that people talk about a lot. They get excited about, but it is probably the closest thing to getting passive income in real estate. You can use cash flow for a lot of different things. You could use it to pay for your kid's college fund. You could use it simply to pay off the property faster, or you could throw it in a bank account and save up for the next property. There are hundreds of things that you could use the cash flow for. But the really cool thing is that investment properties generally start to give you cash flow, if not in year one, certainly several years down the road as rates go up and rents go up in the area and all that kind of stuff. But let's look at a side-by-side comparison, because I think proponents of stocks will come back and say, well, stocks can give you dividends, right? Very similar concept. So let's look at these side by side. If you look at last year's Vanguard Mutual Fund. Okay, it's one of the most widely known mutual funds that's people say, yep, this is going to provide you really, really good dividends at the end of a year. Okay, that mutual fund paid out 1.59% of the investment in dividends. So just to kind of lay it out there, if you invested $10,000 at the beginning of the year in this fund, at the end of the year, you made $159. It's not really something to get excited about. That is literally the amount of money, about 150 bucks. That is my minimum standard for cash flow per month on my rental properties. If I'm not making $150 in cash flow per month on my rental properties, I don't think it's a good investment, much less $150 over the course of the entire year. Okay. So here's the fun thing for me is think about yourself 10, 15, 20 years from now. You're sitting there and you have 2, 3, 4 multiple properties that are fully paid off and they are cash flowing. They're cash flowing $1,500, $2,000 a month. That starts to become a really, really exciting picture when each one of those properties is cash flowing a significant amount for you. So just another example of why property investing in real estate is really, really exciting and why I prefer that avenue over investing in the stock market. So point number 3, a hedge against inflation. To be totally forthright, this was one that I really didn't give a lot of thought to prior to the last couple of years. I just kind of, pass it off as, oh yeah, it's a good talking point. We now see the dangers of inflation after going through the last couple of years and seeing 8%, 8.5%, 9% inflation year over year. It's a huge, huge risk. And it's something that's really going to eat into the returns that you have depending on your mode of investment. So as an example, if you were investing in the S&P 500 last year, you would have to get between 8 and 9% returns just to break even on inflation. That's pretty tricky. Now, sadly, looking at the S&P 500 over the last 12 months, it's actually gone down by 15%. And so you have to do really, really well in the S&P in order to try to make your money back. Conversely, let's look at real estate. Okay, over the last 12 months, real estate has gone up by about 8 to 9%. Okay, so right about at that appreciation trajectory. So you've broken even and you're doing okay in that regard. Rental prices have actually gone up by 15%. And this is in the Denver metro area over the last 12 months. So again, you're covering inflation with home appreciation and with rental rates versus the S&P 500. You've actually lost quite a bit of money because of inflation and because of where the market has gone. So again, just another reason why I think real estate is a really, really safe bet, especially when you're taking into consideration inflation. The next 2 topics I want to talk about, it's more about feeling safe with analyzing and what you are investing in. And the 4th point here is that it is so much easier to become a knowledgeable investor with real estate. So I like to kind of put together a premise here, but let's say regardless of what your investing goals are, let's agree that if you want to be successful, you need to be an educated investor. Okay, I think we hopefully would all agree that that's the case. Absolutely, you could go and there are what I like to call like dummy-proof index funds. You could go out there and invest in one of these index funds. They are pegged to different markets. There's very, very little research that you need to do. You're really diversified. But even still, if you invested in one of those funds, you'd probably need to do a good job of saying, okay, how much of my portfolio do I put in this index fund? Because this is a little bit more aggressive. And then how much do I put in maybe some bonds or a more conservative fund? And then how much do I balance those as I go through my career to make sure that my portfolio is properly balanced and I'm not taking too much risk, right? There's a lot that starts to come up and you should be educated if you're investing. So the point is that if you're doing this correctly, you need to take some ownership and you need to be educated in one way or another. And so if we're taking that approach, it is so much easier to become educated in the market of your own backyard. And by that, I mean the city where you're living, where you go get coffee every day, where you go to work. It is so much easier to say, hey, I know the neighborhoods around me. I know the neighborhoods where I live in. I know the neighborhoods I really like to go to for great coffee shops or have restaurants, all of that types of stuff. It's so much easier to know all of those things as opposed to trying to find out things about specific businesses. Even if you wanted to, there is a plethora of information at your fingertips that you could find out about a city if you knew nothing about it, like which school districts are good, which areas have the best and the worst crime. There are so many ways to find out all of this information. Now, uh, conversely, let's look at if you were investing in a single company in the S&P 500 and you were trying to identify certain information about them. Let's just say you're investing in Apple as an example, right? You'd want to start to do some research to know, is this a good investment? You'd want to know everybody on their leadership team, their backgrounds, how long have they been at the company? What's their track record? You'd want to know, what are the best selling products for Apple? What do they have lined up for the future? Where are they thinking they're going to make more of their revenue? You want to know all of these things in order to feel comfortable investing in Apple. That's a lot of information to find out in one company, much less the dozens or hundreds of companies you might be investing in if you're doing some sort of mutual funds, index funds, diversifying. So as a quick summary, it is so much easier for you to become an educated expert or really knowledgeable about your market than it is to become knowledgeable and feel good, feel safe with your investment if you're looking at investing in the stock market. So last point for today, and again, it's a very similar concept to the last one, is real estate is much easier to value, okay? There really isn't a much more objective process than the appraisal process, which is finding an impartial person, okay? They have zero relationship to the seller or the buyer, and they really don't care where the number comes up as long as they use past historical data that's backed up of properties that are similar. So the property that they're looking at right there, as they call it, the subject property. It's a really impartial and objective way to look at it. And honestly, property values, even though they trend up or they can trend down, they don't have these crazy fluctuations. It's pretty easy to say, yeah, this price feels right about a home or not, okay? Now, stocks, on the other hand, they can be extremely volatile, right? They can go up or down by 5 or 7 or 10% simply based on what's the new report of the day or what's the most recent macroeconomic trend, right? Those things happen all the time, and they're trying to take into consideration what's forecasting going on like now? What are our current earnings? Are we hiring for jobs or are we cutting jobs? What's going on in the macroeconomic environment? There are so many things that affect stock prices, and they move so quickly and so drastically on any given day. How can you literally look at that and say, yeah, I feel really good. I feel really safe about the price that I'm buying this at. And I feel like this is a good investment for me. So for that reason alone, I also feel like real estate is a much less risky investment because it's much easier to determine the value and therefore reduce your risk in the investment, so to speak. So those are the first 5 points. We dove into a lot. We're going to talk about the next 5 points next week, and we're going to dive into some of those interesting topics and that kind of thing. Hope this helped. Feel free to shoot me a question or anything like that if you want to via text, phone, email, and otherwise have a rocking weekend. Cheers.